Okay, so this is an extension of the notes receivable part of the chapter. And in this section, let's talk about notes received for properties, goods, or services. So when a note is received in exchange for properties, goods, or services, a bargain transaction entered into arm's length, the cash sales price is presumed to be fair unless there is no stated rate. The stated interest rate is unreasonable. The face value of the note is material different from, so the face value of the note would have to be material different from the cash sales price for the same similar items from the current market value of the instruments. And here we have an example where Oasis Development sold a corner lot to Rusty Pelican at a restaurant site. Split of 5-year notes, no interest rate. The original land cost $14,000. These are all, obviously this is an example of a trade receivable, by the way. And the date of the sale of the land had a fair value of $20,000. Given the criteria above, Oasis uses the fair market value of the land. $20,000 is the present value of the note. Oasis therefore records the sale as. So this will be notes receivable. This is going to be a discount. So we're taking the present value minus the fair value, which will go over here. So this is the fair value minus the cost. And when you have the fair value minus the cost, you get a gain or a loss. Now here's the land, and that's going to be at the cost, $14,000. So that is basically it. And choice of interest rate, if a company cannot determine that interest rate, stated interest rate, and if a note has no ready market, determining the market rate of the note is more difficult. To estimate the present value of the note under such circumstances, the company must approximate an interest rate that may differ from the stated interest rate. The process of interest rate approximation is called imputation. So really you're just in a situation where you don't know what the actual interest rate is. It's hard to really pinpoint the present value of the note. You know there might be a difference between the stated and the market rate, or the stated interest rate versus the interest rate. And you have to impute an actual interest rate, and that's called interest rate approximation or imputation. Okay, so valuation of notes receivable. So companies record and report short-term notes receivable at their net realizable value. That is their fair value minus all necessary allowances. The note receivable allowance account is allowance for doubtful accounts, like we did before. The computations and estimations involved in valuing short-term notes receivable and in recording bad debt expense and the allowance account exactly parallel that for trade accounts receivable by utilization of either a so I think this will be something around the lines of percentage of sales or analysis of receivables, but let me double check. Percentage of sales revenue and analysis receivable, just like we did in the last example for the allowance of doubtful accounts. Approximation, which is not the direct method but the allowance method. Okay, impairment. A note is receivable is considered impaired when it is probable that the creditor will be unable to collect all amounts due. So that would be, principal and interest, principal and interest, contractual terms of the receivable. Principal and interest of the note, obviously. So this is an example where you have, again, we're talking about an allowance the allowance method, not the direct method, the allowance method that is material. So we're talking about material values, which can be impaired. When they are impaired, you have to use that percentage of sales revenue or analysis of the receivables to calculate.